Selfwealth Live, technical analysis edition, or I'd like to call it more like a traders edition. I think we've got to we kind of come up with a better name, don't we, Jason? But this is my co-host here on the side here, which is Jason McIntosh. Thanks, Jason, and welcome to you. How are you going today?
Hey, Roger. Yeah, great to be back on. I think this is, what are we up to? Show number 3. Actually, show number 4. So we're getting into them. And it's been good fun. Hopefully the viewers are coming back and enjoying the content. So yeah, looking forward to today. I think we've got some good stuff with risk management to go over.
Yes, exactly. We are talking about risk management today, Risk Management 101. Now, we're going to have a sort of couple of sessions on this, actually, because there's a lot to cover, right? But this will be the first sort of installment, Trader Risk Management 101, as we've called it. But speaking of risk management, we've also got to speak of disclaimers, don't we, Jason? You want to?
Yep, and let's just do that now. So just a quick reminder for everyone, everything we talk about today is general advice. So nothing takes your personal situation into account. Have a look at the information up on the screen. Pause it if you need to, just have a quick read through it. An important point to make is I'm not from Selfwealth. I'm Motion Trader. So my business is Motion Trader, and I come on to talk generally about all things technical and market. So I operate under a different financial services license, one provided by Chartreuse Wealth Management, and you can see their number on the slide. So Chartreuse license number is 422409. So yep, just keep that in mind. General advice. And with that said, let's jump back to Rob.
Thanks, mate. I just want to thank everyone so far. We've made it to 4 weeks, which is good. I'm loving just the number of people that are coming to watch us already, right? And watch the education that Jason has been so kind to give us here at Selfwealth, or as clients of Selfwealth, or even if you're not a client. I'm just grateful for it, right? And it's already helping me being a better trader on my side, and I hope it helps everyone on their side as well. And even if you're just an everyday investor, there's things in this which are absolute gold when it comes to investing as well, right? So I'm really grateful for your time, Jason. And that said, let's get into our first question for today. So basically, we're talking about risk management. What is risk management in your eyes, and how important is it to have some sort of risk management around your trading?
Yeah, look, risk management, it's such an interesting topic. Really, it is. It doesn't, on the surface, risk management mightn't sound interesting, but it's fascinating how it all comes together and how it's such an important piece of trading. If you're going to act in markets, you've got to have risk management. And risk management is really your defense strategy. And defense is such an important part when you're operating in the markets. And defense, of course, is all about, in the markets, it's all about minimizing your loss of capital. So you're always going to have losses when you're in the markets, but you want to minimize those losses as much as possible. And that's where your risk management really comes into place. And it's like, you think, like, if you put it into sporting terms and you think, look, every great footy team, it's a combination of attack and defense. So you don't win the flag by being a great attacking side or a great defensive side. It's really that combination which wins you the premiership. You got to be both. But I think when it comes to the stock market, a lot of people instantly go for the attack, in these terms, attack is all about, what stocks am I going to buy? What stock's going to make me a lot of money, and that becomes a dominant focus. And but it just doesn't work out so well if that's the way you approach it, because your capital is key. Without your capital, you can't play attack. So you've got to be always thinking about, how do I defend the money that I have? So the first thing I think anyone should do when they come to the markets is, they think, what's my defensive strategy? How am I going to protect my capital so when I get something wrong, and you're going to get something wrong a lot, that's just how these markets work. Anyone thinking they're going to get a 90% win rate, it doesn't work like that. You've got to be able to withstand those times you're wrong. That's all about your defense. It's like a bit like the soccer team that, say a soccer team comes out and they go, okay, we're just going to have strikers. We want all all forwards playing. We're not going to worry about defense. It's all about attack. And that's great when you're going for the goals, but when the ball gets past them, it's a goal fest on the other side, and it doesn't work out. So we've got to have that attack and defense. And I think that look, a lot of people look. I can understand why people focus a lot on what stocks to buy part. It's like you look at the internet forums and the news services where it's all about what are the best stocks to buy for 2023 or the best stocks for next month, and research on broker reports is that most of the recommendations are skewed towards buying. So this is why we've got this focus on what to buy, and you don't see enough articles or a lot of information or enough education about your defense strategies, and that's really what we want to go through and talk about today. I want to give you a quick example of why defense is so important. So I'm just going to just do a little bit of behind the scene work and share my screen with you. So I'm going to show you a stock from my own portfolio. And I like showing stuff from my own portfolio because it makes it real. It's anyone can come up with a hypothetical example, and sometimes hypotheticals are good. That's the best we can go on. But when you've got something real, it's even better. So this is a stock I bought. It was back in May 2021. I'll explain why I'm using this example in a moment. So it's a stock called Kleos Space. It turned up in my motion trader signals, so a lot of my members would have bought this stock as well. And you can see this first green circle. So we had a situation where we've got a stock which is in an upward trend. We've got these rising moving averages. We're going to talk about moving averages another day, but you can generally see these rising moving averages, and it broke up to a new high. So it had all the characteristics of a stock which had the potential to continue running. And it did for a few weeks, but then it started to stall. It started to break down below the moving averages, and then it came down and it hit my defensive strategy. And my defensive strategy is a stop loss. I'm going to talk about that a little bit more later on. And so I was out of the trade. So it's a loss, and it's like, it's just the cost. A loss is a cost of doing business. You're going to get them. It's all part of the process. There's nothing wrong with them. You just want to manage them. You want to manage the risk around those losses and keep them relatively small. So now let's just think for a moment, how do a lot of people, and this is well documented, it's well studied, and this is what actually happens, not just me making up scenarios. How do a lot of people handle this sort of situation? Well, for those who don't have their exit strategy, for those who don't have their defensive strategy, what they tend to do is one of two things. They'll either hold onto the stock and hope it comes back. They might say, look, if it gets back to even, I'll then sell and I'll get out then. I just don't want to lose any money. I'll get out at break even. A more aggressive approach might be they'll say, look, I'm going to double up. Let's buy some more around where this green circle is. So that way it only has to get up into, maybe up into the high 80-cent region, and then I can sell and get out at even. So imagine someone's approached Kleos like that. So let's just start moving forward in time and see how this plays out. And this is typical of a lot of stocks. Not every stock, of course, will do this, but it's not an uncommon situation. So this stock continues to decline, and this decline goes on for some time. So what are you doing now? Like, what's your defensive strategy? If you've doubled up or you're still holding after buying at some point earlier on, even if you bought it on the way down thinking this is great value now what are you doing? What's your defensive strategy? And this is where so many people fall apart and their portfolios become a wreck, is because they don't have a defensive strategy for a stock that goes into a tailspin. And let's just continue moving this along, and the tailspin continues. So why have I shown this example? Well, I was doing my weekly portfolio, my database management, which I need to do for my motion trader service. I go through and I update the data behind the service each week. So I've got to update delisted stocks and new listings. And Kleos turned up in the ASX delisted stock list. So it was delisted last week. So anyone who has been holding and hoping for a recovery, it's been an absolute disaster. They're basically down 100%. Now that's completely avoidable. No one should be down 100% because we've got risk management strategies, which we're going to go through and talk about. And it just reminds me of a great quote. Now this really was a career-making quote for me. It's from a guy called Larry Hite. And Larry's one of the pioneers of system trading, algorithmic system trading. And this is what Larry says. Larry says, if you don't bet, you can't win. But if you lose all your chips, you can't bet. And it's such an interesting statement when you when you think about it and you break that down, because this is what risk management's all about. You've got to bet if you're going to win, so you've got to be able to like play attack. You've got to be able to put your positions on. But if you lose all your chips, you can't bet, and you're out of the game. And for me, that was a career maker, just learning that early on, and it really made a difference to how I approach markets and what I've done moving forward. And it looks like we've lost Roger. It looks like his internet's dropped out. So you've all just got me for the time being. So what Roger and I were going to talk about next, we're going to talk about the what sort of position size that I normally take. Like how do I set my positions, and like, am I using some sort of a monetary process, or is it percentage base? And then also, how do I calculate what sort of position to put on? How do I work out? How do I know how much to invest in each stock? And this is an interesting component as well, because you've got to be able to understand how. Oh, we've got Rog back.
I'm back. Sorry. So I'm back up internet. I'm back up internet, and I've just got my son in the other room on the bike, just running the power here. Sorry, guys. All right, we're back.
So,
go for it, Jason.
So I've just introduced the next question, but I'll let you do it because you'll probably do it better. So we just finished up talking about what risk management really is all about.
Yeah, fantastic. Yeah, once again, sorry guys, I wasn't sure who went out then, because Jason just went frozen on my screen, and then I realized my NBN has all gone down, so I'm on backup internet here. So yeah, obviously for me, we were talking about last week. We started talking about position sizing. So this week I wanted to talk more about what your specific position sizing is, Jason. What would you normally take? Yeah, what kind of position would you normally take?
Yeah, look, I want to take you through one part of my investing world. So there's various things I do, and one of them is running my Motion Trader service and running a portfolio off that. So I'm going to go back to a bit of screen share. So just let me just do this behind the scenes. And where are we? So this is my website. This is on my Motion Trader website. If you come to my website, motiontrader.com.au, and you go to About, and you go down to Jason's portfolio. And so it's saying which updates, it's almost live. It's a 20-minute delay. So it's as good as live. And so what I did, and this is all going to lead into like my position sizing. So what I did it was September 2015, so almost 8 years ago to almost 8 years ago to today, really. It's I set up a portfolio. It's put $500,000 into a standalone portfolio, and the aim was I wanted a portfolio that I could use to trade the portfolio the same way, using the same processes I'm using for my Motion Trader service, because I think it's really important that if you're going to talk the talk, you got to walk the walk. And too many people I see talking about stuff, but then you find out they don't actually do it themselves. It's for me, you've got to be able to do what you talk about. So I put that $500,000 into an account, and it's now worth 1.2 million. So we've added 700,000 in around 8 years. So this graph here, you can see this is plotting the overall gain. You can see it starts at zero, not $500,000. So it's taken the capital out. So it's and this is showing all the profits, the losses, it's got the transaction costs, dividends, franking credits. Pretty much everything goes into this, and this is a pretty close match to what.
Sorry, Jason. I've just sorry to stop you there. I think we've just got I don't know if you need to share another one of the screens, because we've just got the Cleos Space SA technical chart up there, trading view chart up there. So if we just want to switch screens there.
Right. Okay. That's a little technical issue I'm now aware of. This is the thing with sharing these screens. Here's the one.
That's the one. Yep.
That's the one we're after. This is the one I've been talking about, and people have been wondering what on earth is he talking about. So yeah, when you come to the Motion Trader website, motiontrader.com.au, you come to the About section, you click on Jason's portfolio, and this is a graph. This shows my performance. My $500,000 portfolio is now the $1.2 million portfolio over the last 8 years. So, and what's happened during this, I've had to determine my position sizing. So how does my position sizing change? How do I manage an account which starts at $500,000 and has grown over the 8 years? And this is one of those things which I think is it's a tough thing, I think, for a lot of people to get their heads around. I think even a lot of professionals find it hard to get a strong grasp on how they're going to size their positions as their capital grows, or in some cases maybe it falls. Like what do you do? And I remember back when I started my career, it was early in my career. It was my first trade. It was actually my first trade I remember taking. I asked the head of the trading desk, I said, look, how much should I risk? And he said, look, just risk a few $1,000s. And so it was pretty vague. And so a few $1,000s, I thought, look, $4,000 or $5,000 of the bank's money, I'll risk that. And that's sort of like how I started. There wasn't a set calculation to use. And when I looked around the dealing room over the following years I was there, and it's like a lot of the guys, they would size their positions based on their conviction of a trade. It was quite discretionary. It wasn't really a calculated process. And that's not how I'm trading my portfolio now. So what I do now, there are three general approaches to how people size positions. And let me just come back to our live section. And now these are the three position sizing approaches that are widely used. So we've got the discretionary approach. That's kind of like what I was like my start in the dealing room was saying, look, risk a few $1,000s. So you're making a discretionary call on how much you're going to risk. Then you've got the fixed trade size approach, and that's where you might say, look, every trade I'm going to put $1,000 on or $5,000 on. And then there's the percentage of capital approach, and this is the way which I use with that portfolio, which I was just showing you. It's using a percentage of the available capital to invest in a stock. So just going through some of the let's just go through some of the advantages and disadvantages of each of those approaches. So starting with that discretionary approach, like the advantage of having a discretionary approach to your position sizing is that that's flexible. You can vary it depending on how you feel about a particular situation, but the disadvantage of that is that it lacks structure and it's inconsistent. So I think one of the greatest risks of that discretionary approach is that you have the least money on your best ideas and your most money on the ideas that don't work out. So it can become quite lumpy in terms of how your performance works. It's I think a better approach is finding a more structured way of determining your trade size. So that brings us to that fixed trade size, and I think the advantage of having that fixed size is that it's easy to apply. So it's pretty easy. You got a trade idea. You say, okay, I'm going to put $5,000 on it, and I know what my risk is going to be, and that's pretty straightforward. The problem with the fixed trade size, though, is it's harder to scale. So say you've made a bit of money, you keep investing $5,000 in a stock, it's hard to grow. How do you go from $5,000 position to a $7,000 position to a $10,000 position? The fixed trade size it's not flexible enough to really help you grow. This is the beauty of the percentage of capital approach, because the big advantage is that it adjusts to your capital base. So when I was trading a $500,000 portfolio, I might have been having say a $6,000 trade position. Now it's a $1.2 million portfolio. That's increased, and I'm currently trading around $15,000 per stock. So the way I'm calculating it, I'm trading 1.25% of capital every time I get a buy signal, and so that means it's consistent. I'm consistent across all of my trades, And so 1.25 in each trade, that works out at an 80 stock portfolio. And look, so 80 an 80 stock portfolio is probably going to be too big for a lot of people. That's not going to suit what they need, and that's okay. You could have like if you got say you got a 20%, or say you got a $20,000 portfolio, it might be 10,000. It might be 10% of trade. That would be a 2,000 position size for each trade. So you've got to work out your position sizing based on what's right for your situation, what's right for your portfolio. But it does make it simpler to increase your position size as your portfolio grows. So your $20,000 account becomes a $30,000 account. And if you're using 10%, well, then it's $3,000 a trade. It just naturally grows with your portfolio. And if you go into a period where the market declines, you start to decrease your risk because you'll be investing less. And one of the beauties of Selfwealth is that your brokerage costs, like $9.50 per trade. So say you're trading $2,000 a transaction, $9.50 per trade is only 0.5% going in brokerage. And that's a big thing to consider when you're looking at what your minimum trade size is going to be, because you've got to keep your percentage of brokerage relatively low. If you end up with brokerage of 2 or 3% per trade, you've got this huge headwind that you're going into, and it becomes really hard to get ahead. So it's really good when you can keep your brokerage low. So my brokerage is like $15,000 a trade, and I'm paying $9.50 in brokerage per trade. It's like it's minuscule. It doesn't matter. Brokerage isn't a significant cost for what I'm doing. And look, and so that's how I'm position sizing, percentage of capital. So it's a really good way to manage a capital base and keep control of risk.
Yeah, no, it's good insights there, Jason. I just have to point out on your graph, obviously, just that past performance doesn't equal future performance, obviously, as well, because I think a lot of people would dream to have that sort of capital return. Even big money managers would dream to have that sort of capital return. So we can't obviously ever guarantee that that's going to happen if you follow, everything to a T that we talk about, right? So,
and the thing is, it doesn't go up in a straight line. It's got
explain those dips for us there, Jason, and how do you cope with those dips?
It's got those pullbacks along the way, and that's a really important concept. Actually, let me just go back for a sec, because this is a point which I really try to make all the time. It's like people will look at a graph like this, and is it showing up on your screen, Rog?
Yes, it's up there. Yep.
Excellent. I want to make sure I didn't make the same mistake as before. So people will look at an 8-year performance and they'll see the big sweeping upward move and go, well, look, that's fantastic. That's easy, but it's not easy, because the big sweeping upward moves are going to be punctuated by these periods of drawdown. And like this is during the COVID period. This was like the portfolio went from being up about $500,000 to being up $320,000. So that's $180,000 drawdown. So you do get the pullbacks along the way. And this is during the past this is during 2022, that ugly period we had there. You get the drawdowns. It's not all just about winning all the time. It's about having a process, having a strategy that can see off these inevitable periods where you get losses. And this is why we have the position sizing. Like I'm using 1.25%. So, I can decrease my position size when I'm losing money. And I've got a process. We talked about process last week. It's all about following a process and staying in the game when conditions get difficult. And the other thing which I didn't point out before, you can actually come down a little bit further and can actually see the stocks in my portfolio and sort of see how I manage them. And so these all started out with pretty much around using that 1.25% rule. And so I'm going to order them by return. I'm just going to click here. So this is my best performing stock at the moment, a stock called Duratec. You can click on here. You can see where I got in October 2022, and then you can scroll down the portfolio. So this is like there's plenty of good wins in there, and this is all about letting profits run. We'll talk all about this sort of stuff another day. But then you come down and you can see there's losses there too. And this is what we're talking about today. It's about, I'm going to talk about stop losses a little bit later. We talked about a little bit with Cleos, and you can see I've got a couple of stocks here which are now really close to their exit stops. And that's my defensive strategy, is going to clean these two out if they continue to fall away. And now you might think, look, he doesn't have too many losses there. He's got a lot more profits, but that's because of my defensive strategy. My defensive strategy is cutting these guys out relatively early. I'm not hanging in there and hoping they're going to rebound. When a stock's in the red, they leave the portfolio. So I have plenty of losses. Losses are part of the game. No one should go into this thinking, I just want to see green. And a bloke told me that once. He said, I only like green in my portfolio, but it doesn't really matter what we like. It's what the market gives us, isn't it? And you're going to get the red, but it's what you do with the red. What's your risk management strategy? What's your defensive strategy for dealing with the red? Because it's a lot of people don't handle the red very well. And if the red gets out of control, your portfolio is toast. You've got to be able to have that defensive strategy. I can't emphasize it enough, so I'll go on and on and on about it because it's so important.
Yeah, I mean, I've always been told, doesn't matter what educator I hear or listen to, obviously protecting your capital is the most important thing. Not how much money you make, but how to protect your capital is the most important thing, because you can't go on another day if you've lost all your capital, right? And I'm pretty sure most that have been in the trading game have probably blown up a few accounts here and there. I know I have. So, but trying to educate people on protecting their capital from the start, and if they actually listen, is probably one of the, or do this, then it will save them money going forward, right? If anything. And I think one of the questions out of what you were talking about before, not a lot of people will be able to manage 80 stocks in a portfolio. I know certainly my limit is, around 15, to be honest, but it also depends on the amount of capital I have as well, right? How would someone decide how many stocks they could manage? How long does it take, per week for you to manage 80? And maybe that's somehow, that's how someone can actually decide how many stocks they would like to manage, right? So,
I think the your capital base is going to be a big determinant. If you've got $20,000 in capital, you're not going to have 80 stocks. At 20,000 of capital, maybe you're doing $1,000 or $2,000 per trade. Well, then you're looking at 10 to 20 stocks. $40,000, you've got a little bit more flexibility, and so on. So that's probably going to be the starting point. But it's like, I say to people, look, I can have up to 80 stocks in my portfolio. And it's like, how on earth could you manage that? It's actually not that difficult. It doesn't take me that much management time each week, because I'm not short-term trading. This is more position taking. It's sort of like, I describe this as what I do as active investing. I'm looking for stocks that I can potentially hold for 1 to 2 years, which have the potential to rise significantly in value. So there doesn't need to be a whole lot of portfolio turnover. Once something starts moving, I can just let it keep moving until it stops going in the right direction. If I get a Cleos, well, then I'll take action. But even that Cleos example probably took 2 or 3 months to exit. So even the losing trades, occasionally you get something which rapidly deteriorates, but more often than not, it takes a bit of time. Using my approach, there's all sorts of different approaches. There's short-term, medium-term, there's buy and hold. It's just what I'm doing. It's not, I can have an 80 stock portfolio and a week could go past and I don't need to buy or sell anything. That said, you'll get a period like the COVID crash, and I get kind of busy because there's a lot of stuff triggering exits and you've got to exit things. So, but fortunately, those events are relatively rare. I think to have a larger portfolio, you need good software, really accounting software, just to track your entries and your exits, so you can do your tax at the end of the year. You know where your dividends are, so you're organised. I think the days of being able to use an Excel spreadsheet, it's like that's long gone. It's too cumbersome. So just investing in some good portfolio tracking software, pretty inexpensive stuff to get, and
what percentage size? What percentage size would you recommend someone who's just got a 20 to 50K account? 1%, 2% to start off with. You said you use 1.25%. Did you start at 1% and then it went up, or how did you decide that 1.25%?
I decided based on the number of stocks I wanted in the portfolio. When I started with this $500,000 account, I actually had 40 stocks in the portfolio. So I was trading 2.5% of capital per trade. And during the COVID sell-off, I found that because I trade whilst my motion trader service covers the entire market, I filter out the top. I think it's the top 300 stocks. So I'm looking for stocks in the small to mid cap range, because that suits me, what I'm doing. It won't suit everyone, but it suits me. I like those high potential stocks, those small to mid cap stocks, which could get a lot larger. And so everyone's got limited capital, and you've got to decide, well, what stocks am I going to invest in? I've got to have some sort of filtering mechanism, because there's always going to be more opportunities than you have capital to invest in. I accepted that long ago. So that's what I do. I take those bigger ones out. And so we had this COVID crash, and liquidity became quite difficult. And I decided maybe a better way going forward would be to have more stocks in the portfolio, but because I'm trading the smaller end of the market, I can be nimbler if I have less invested in each stock. So now a typical trade size with the portfolio size will be $15,000. Had I been still doing 2.5%, then it's $30,000. Moving $30,000 through some of the smaller, less liquid names is a bit cumbersome, and particularly when the volatility picks up and liquidity dries up. So that's why I've done what I've structured it this way for me. So that's why I say everyone's got to do what's going to work for them. If you're trading large caps, maybe you can have a smaller portfolio, because you'll be able to move money through, and it depends on how much capital there is there in the first place. So look, for someone with a $20,000 portfolio, maybe they're looking at 10% in each stock. And this is just general, like everyone's got to do what's right for them. It's just general. So 10% in each stock would be $2,000 per stock. When you look at the percentage of brokerage paid, we spoke about a moment ago, that is like around 0.5% for coming in, 0.5% for going out. That's okay. So that could be a starting point. If someone's got a $40,000 portfolio, well, then they might say, well, maybe I can do 5% per stock. So that would be a $2,000 per stock situation. But then they're able to have 20 stocks instead of 10 stocks. So people got to play around with it a bit for their situation. But I do think it's important to spread risk. So rather than just saying, look, I've only got $10,000, so I'm just going to put it all on one stock. It's like, still look to spread your risk. It's about having many relatively small trades, and this is for my approach, is for having many relatively small trades, not a few big ones. Because if you bet big and you lose, you've got a problem. But if you spread your risk and something happens which causes a stock to fall heavily and quickly, if it's like for me, 1.25% my portfolio in each stock, a stock could go to zero overnight. It's going to be annoying, but it's not going to be a portfolio destruction event. It's just going to be going, okay, well, that stock's gone. Probably won't happen, but it could happen. And so spreading risk is important, because spreading risk is also insulating yourself from big negative unexpected events. So I'd suggest everyone should consider having that diversification in their portfolio, more than like 2 or 3 stocks, looking for at least 10 stocks, maybe 20 stocks, maybe 30 stocks, somewhere in that range. And that's you're reducing the risk associated with any single company.
Yeah, it's gold. That information doesn't matter if you're a trader or if you're a once every now and then investor. I think it goes back to also what we were talking about last week in the processes or your rules, and you probably should have that defined in your rules so you try and stick to them, like the amount of stocks I want to trade, in my portfolio, the percentage of risk I want to put down per position. I think they're great things that could potentially go into your rules that you would have written down as a trading plan, right? So, and just on that note, obviously, guys, if you haven't seen last week's one, firstly, like and subscribe on these videos, because it helps with what we're doing here, obviously. That just doesn't make us feel good, but it will help this sort of idea of keeping these chats going, obviously. But go see next week where we last week, sorry, where we talked about having a set of rules defined. I think that's a really, really important thing, and I know it's helped me with my trading. Sometimes when I want to take a bigger position, I'll go back to my trading plan and I'll go, hang on, that's not what I wrote down originally. I need to sort of stick to the plan. So I think that's really good there, Jason, what you've sort of said there. Now, can I ask another question then? Have you, like, what other strategies have you used in the past? What sort of stop loss trade, like the one you use now? We were talking about stop losses now, right? What's your stop loss limit? And I know we're going to get more into this next week, but what's your stop loss limit at the moment?
Yeah, look, stop losses are a really, really important thing to discuss for anyone who wants to actively manage a portfolio. It's a key part of the defensive strategy. So last week we spoke about, it was all about process, and one of the pieces of the process was, deciding how much to invest. So we've spoken a bit about that. And another piece of the process is deciding, how do you decide when to sell a stock which isn't doing what you thought it might do? In other words, the stock's falling. What do you do then? How do you handle a stock like Cleos? What do you do? And there are various strategies for using a stop loss. So let's just go through the three common types of stop loss. So you've got the discretionary stop loss, and this is a sort of stop loss which I've used a lot over the years. And a discretionary stop loss is one which you're using. You may have some sort of a process in your head, but it's not a fixed calculation which you just automatically apply to each trade. So the advantage of this, it can be flexible, and it's you can actually potentially build a large position whilst keeping your risk relatively low when you're using a discretionary stop. So I'll show you an example. From my portfolio. This is I'm going to show you a stock that I did on a discretionary basis. So this is actually in one of my motion trader stop signals, but I didn't do this in my own motion trader portfolio because the portfolio was full. So I did this in a separate account. So this is a stock called Bannerman Energy. It's a uranium stock, and it's an interesting one. We won't talk too much about the chart features today. We'll talk about them another day. But it's a stock which did really well during 2021 into 2022. Then it peaked with the entire uranium sector. It's gone through a couple of years of falling prices. And I love these structures where you get a stock which goes from below the moving averages. So I'm using a 50 and a 100-day moving average. A stock that goes from below averages to above, and then starts to consolidate in a compressed range. You can see these blue lines. This is this compressed range where it comes back to the moving averages. Then we can see the moving averages cross and turn higher, and you also see this downward trend channel. So we had three things happening at once. We had a stock breaking out of a compression range, breaking out of a trend channel, and starting to rally above the moving averages. So I got a motion trader signal on, I think it was around the 10th of August. And as I was saying, my motion trader portfolio didn't, for myself, didn't trigger a signal because it was full. But I have money in other accounts. And I thought, look, I want to play this stock, and I thought, look, what if I buy it around? I don't want to buy this spike higher. I'll get it on a bit of a pullback, and I put an order in at around $1.80. And I thought, okay, now where am I going to set my stop loss on this? And this is a discretionary stop. I looked at the chart, and a classic way to do a stop loss on a discretionary basis is to use a previous low point. So see this low here from a few days earlier. I'm just going to draw something in so we can see it a little bit clearer. So yeah, just around there, you can see this low. So I got out the calculator, and I said, okay, if I buy at $1.80 and I set my stop just below here, actually looked at around 15%. So the idea is not to have it directly beneath it, because that's an obvious place for stop losses, but a little bit further. So I thought, okay, 15% below, I can put a stop loss, a discretionary stop. then I thought, look, I just want to risk a few $1,000s on this because I've already got plenty of uranium exposure. So I thought, okay, look, I'm just going to risk $3,000 on this. 15%. So how much can I buy? So the calculation is you go, okay, I want to risk $3,000, divide that by the stop loss. So it's 15%. So 3,000 divided by 0.15 is 20,000. So I could invest $20,000 in Bannerman, set my stop loss 15% below, and so I got in. The stock pulled back over the next few days. This is something I'll discuss in a moment about if you set really close stop losses. Like what happens if you get a bit of a pullback before it runs? So we got that pullback, then it ran, and now it's doing quite well. So this trades off to a nice start on a 15% risk. So this is one of the great things about these discretionary stops. But the thing is, you need to know where to put them, and unless you've got those skills to sort of like understand the price action, they can be a bit tricky to work out how to deploy. So in that case, maybe you're looking at something like those discretionary, like those other stops we were talking about, which I just had up on the screen. We look at the percentage stop. So if you don't have those discretionary skills to sort of work out where the price action suggests a stop loss should be, you could use a percentage stop. Now, the advantage of the percentage is really easy to calculate and apply. You've just got to decide what your percentage is going to be. Is it going to be a 10% stop or a 15 or a 20% or a 10%? What is it going to be? And part of the answer will be dependent on what you're trying to achieve. If you're trying to trade a stock over the next 2 weeks, just swing trading it, you probably don't want to have a 25% stop loss. It's too big compared to what you could potentially make. If you're trying to get a stock like Bannerman, which could potentially double in price, well, then you can afford to have a 15 or a 20 or a 25% stop loss. So that's a percentage one. It's it's a quite straightforward one to apply. And I think the big advantage is that it's easy to use, it's consistent. The thing I always say to my members of my Motion Trader service is we don't know what the market's going to do next, but if we know what our exit point is, we know what we're going to do if the market falls too far. And that's a really important thing to be able to say, to know what you're going to do if the market falls away. I think another point to make about having, if you're using a percentage, and a lot of people say, look, I don't want to lose very much, I'm going to use a 5% stop loss. That could be okay, but the thing to realize is you're probably going to have a higher loss rate with a really close trailing stop, because you get situations like you saw in Bannerman where it will pull back and then rally. So it will just naturally trigger more. You have a higher loss rate. Not necessarily a bad thing, but it's something to be aware of. And the other type of trailing stop is, this is the one I use myself. It's called an ATR stop, or an average true range. I'll go a bit more into this next week, but it's basically a volatility adjusted stop. It's taking the average trading range of a stock and you're using a multiple of it, and it'll adjust. It will adjust to each individual stock based on what its volatility profile is. So I think it's a really good way to approach stop losses, but there is more work in it because there's more calculations. You've got to get all the trading data on the trading ranges of the stock. So it's not as simple to apply as that percentage base. But Roger, I think, look, the big difference between those who are successful in the markets and those who are unsuccessful, I think it comes down to their defensive game. How good are they at playing defense? How good are they at cutting off those stocks which could head a lot lower and cause a whole lot of trouble to a portfolio?
Yep, and being consistent at it. So let's jump to some questions here, Jason.
Actually, sorry, Rog, just before we got to that, part of your question was, is there any other type of strategies I've used? I just went through some of the most popular ones, but I just wanted to quickly show what else can be done. And this is really interesting. It's not one which I usually talk about because it's probably, I don't talk about it because it's probably getting a little bit more complicated. But for some people, they might appreciate that, given that's what we're talking about today. So it's one of the things that you can do is you can and this is using that discretionary process which I spoke about. And this is one of the fascinating things which I love about markets. Like, a lot of what I do is systematic, and it's algorithmic, and it's consistent. But I also love the discretionary approach as well, where you're looking at the price action, you're thinking about it. Because all of my systematic approaches are all based around what I've seen and how I've interpreted price action in the past. And so one of the things which you can do, and this is a way which I've used to build a larger position relatively quickly, with relatively low risk and high upside potential. So sort of like, the dream position, where you can have a lot of upside with potentially relatively small risk. And it's done through stepping through timeframes. So I'm going to show you. This will make sense with an example. So I'm going to go back to my screen sharing. I'm going to show you a chart of silver. This is one I spoke about in my weekly market outlook videos a couple of weeks ago. I was talking about silver. At the time the price action was here, this is what we saw on the chart for silver. And I drew this top line in, and I tentatively drew this bottom line in. And this point here, this most recent low in August, it was too early to say, look, this is a definite line we can put in to form a range. But I said, look, I think based on what we're seeing gold do and other commodities, maybe silver is going to form some sort of a trading range here, and we'll get a rebound off here towards the upper end of the range. It was just looking at possibilities, but based on that, there was nothing to trade. Looking at the daily chart, there wasn't a trade. But what you can do, you can step down through the time frame. So let's, like, when you look at it on an hourly basis, the whole situation changes. So this is that same bit of price action we're looking at on an hourly basis. Let me just expand that a bit. And what's interesting here is you actually start seeing patterns on an hourly basis. So we had the market move from a low point to above the moving averages. Then it went into a sideways consolidation, a compression zone, which I love these compression zones. I talk about them a lot, where it sits back along the moving averages. Bannerman had a similar sort of price structure, if you might remember, compressed up and then broke above these previous highs. So what could have been done then? Now, I didn't do this, so this is a hypothetical, not a real life example. But this is the way I would have. I could have traded this if I was up watching the price action, and the price action happened at 9 o'clock at night, and I wasn't watching the price action then. But nonetheless, this is what could have been done. So you got this breakout, and you go, okay, what's the discretionary stop on silver? So if I were to buy on the breakout, I can measure down to a previous low point. So I can just get back to this previous low here. So say 1%. I can risk 1%. I can have a 1% stop loss, and have a 1% stop loss. So say I wanted to risk $1,000. Say you just wanted to risk $1,000. So 1,000 divided by 0.01 is $100,000. So I can have $1,000 of risk and get a $100,000 position. So that would be typically done through the futures market. So I'd buy one futures contract for silver, or maybe CFDs. So I'm getting a large stake for $1,000 of risk. And then you can see what happens as we move this chart forward a few days. You get quite a big run. Now, let me just jump back to the daily chart. And this is where I say you can step through the time ranges. So when I look at silver on a daily chart, and I'm looking at this range, this was the potential I was talking about in my video. I thought, look, maybe if silver rallies, it might consolidate in the range a bit more, and then it could be getting ready for some sort of a breakout. So what I can do now, had I bought on that hourly basis on a shorter time frame with a very close stop, now I can transition to a daily chart and say, well, look, okay, if silver were to do something like that, that is potentially looking at where the hypothetical entry point would have been. That's potentially something like a 30% gain. So 1% risk, 30% gain, that's 30 to 1. Now, that's what you call asymmetric leverage, and that's how traders can make a whole lot of money. Now, this trade mightn't work out, but if I do a trade like that 30 times, it's probably going to work out a few. It's only going to have to work out a few times, and you're making money when you're getting potential upside like this. So this is what I'm always looking for in a trade when I'm using risk management. I'm looking for where I can risk a relatively small amount to get a potentially large gain. And it's look, I think it's a really interesting strategy. Start with a smaller time frame, and then progress through to maybe a daily chart, and then let that position run, let the profit run, and then use a daily stop loss. And look, you can have something which started out on a 15-minute chart or an hourly chart, which becomes something which might be held for many weeks or many months. And that's how trading can be done.
Yeah, okay, no problem. So, and what's some of the common mistakes when using a stop loss? Deepak has asked us this. Some of the common mistakes.
Common mistake is I think the biggest mistake is trying to hold on to open equity too tightly. So you've got a stock, it's up 20%. You go, look, 20% sounds pretty good. I don't want to risk giving that back. So I'm going to really set my stop loss quite close to the current price. And if it's too close, you just don't give the stock room to move, and it will trigger the stop and you'll be out. And it's hard to then ride a big trend. That's something we can talk about in more detail with trailing stops later on. Other mistakes are, I think the other mistake is just not thinking about your exit point going into a trade, and you haven't thought about the exit. And that's when you get into those situations like Cleos, where they just get out of control because you haven't thought about it. Then they get to a point where you go, well, it's too late to sell now. I might as well ride it out. But some of them, you just ride it into the ground. A lot of stocks don't come back. It's the ASX delistings each week. I'm always updating my database for stocks which have been delisted. Delistings, a regular and frequent event. So you've got to have exit strategies.
Yep, for sure. And once again, being consistent with applying them, I think, is probably a common mistake as well, right?
Well, look, I guess that's right. I do hear that a bit. That's a good point you mentioned, Roger, that people will and one of the things people have said to me is that they say that I need to actually set a live stop loss in the market. It's all well and good to write down where I'm going to get out, but I've actually got to set the live stop loss and have it automatically done for me rather than me having to log on and action it. So, and that's an interesting concept, that it's sort of like then enforced discipline. You set the stop loss when it's a long way away and you're not too bothered about it, and then it's action for you when the time comes, and you don't need to second guess or go, oh, look, will I give it a little bit longer? What should I do? It's just all done. So yeah, for a lot of people, I think that enforced discipline can be a helpful thing.
And we can talk more about the setting of stop losses automatically, because there's a lot to learn about setting of stop losses in the ASX market. Oh, that's for sure, right? And profit taking as well next week. And you gave an example of an asymmetrical trade, which is great, hypothetical. Looking for the large risk to reward trades, which we'll talk about that more next week. I've got a question here from Ken. What are the differences between unleveraged trading and leveraged trading when it comes to risk management? I think the example you gave us before sort of was tending towards leveraged trading. Selfwealth doesn't offer leveraged trading, just FYI. But if you want to answer that one, Jason.
Yeah, it's leverage is simply where you're kind of using borrowed money in a sense. You might put up a quarter of the trade, and then the rest of the trade is money which isn't yours. So that's how it would work with a CFD. That's how it works with a future. There's leverage. The big thing with my portfolio of 80 stocks, I don't set live stops in the market because it's more time effective for me just to sell the next day when a stock triggers an exit. It's not a big deal. If I get out, if it's a little bit worse or a little bit better, doesn't make much difference. If I'm trading futures, I will have a live stop loss in the market as soon as the position is initiated. because when you're trading with leverage, the potential for loss is so much greater. So if my $15,000 stock goes to zero overnight, I won't be happy, but it doesn't materially make a great deal of difference to me. If I've got a position in the futures market and I don't look at it for a week, I could be financially ruined. It's because it's leverage, and leverage can all sorts of things can happen with leverage. Looking at the oil price during COVID, it dropped to, I think, negative $40 a barrel, and which is extraordinary. And that was all because people were caught in positions which they had to liquidate. And you would think it's impossible. In normal times, you think it's impossible anything to fall below zero. But when you're using leverage, nothing's impossible. And if you're the wrong way around, you can be wiped out. So, yeah, leverage is good when used responsibly and used with strict risk management strategies. But, yeah, got to be very careful with the leverage.
Yep, and once again, being Selfwealth, we don't offer leveraged products anyway. You are trading your own capital. On a note, we'll talk about this next week as well. When you do set stop losses in the Selfwealth platform, just be aware it will tie up your capital as well, right? Because just in case the actual stop loss gets triggered, you won't be able to use you won't be able to use that capital because it's waiting to get filled if it gets triggered, right? But we'll talk more about the technicalities around stop losses next week on the Selfwealth platform, obviously. And then when you're using another platform, we can't really speak for that, unfortunately. But yeah, trading over the counter generally is a lot more riskier than on an exchange, right? So yeah. So how about trade risk as a percentage of account size? I think we went over that. Jason, what's your approach if you have a couple of trades that have outperformed, so now overweight, and others just doing average? Trim outperformed or add to underperformers?
This is a terrific question. It's really good because, like, my approach is to let profits run, and some of those stocks can run a very long way. So I had an example. I had a situation with a stock called Jumbo Interactive a few years ago. It was up something like, I think it got to something like somewhere between 500-600%. It was up. So it started off as, at this time I was doing 2.5% per stock. So it started out at being 2.5% of my portfolio, and it ended up being, I can't remember offhand, but it ended up being something like 15% of the portfolio. So that became relatively a big position. So if something really abrupt happened to that company and it fell heavily, to lose 15% of your portfolio overnight, that's a problem. So I really struggled with this, and I thought, look, the reason I have this big profit in the first place is because I've let the profit run, and I'd resisted the urge to take a profit. But now I had a situation where I was thinking, well, what if it were to fall heavily? Because I looked at a chart and it looked like like some of those .com stocks from the 2000s in the way that it had accelerated in the previous couple of months. It really started to look parabolic as more people saw this great performance over the previous 2 years, and then started piling in. And I actually sold a third just to reweight the portfolio so it wasn't such a large portion. And then I let the rest ride out, and then ultimately hit the trailing stop and ended up being around the same price as I took profit anyway. So it wasn't a big deal in the end. But it's just like how I managed that situation. I think resisting the urge to take a profit is how you get those big profits in the first place. But occasionally it's there could be a need to trim them, and it's going to be different for everyone as well. Everyone's got to work out what's right for them. I was okay letting that position run, but look, some people might get to 200% and say, look, I just want to rebalance, and that's okay. But you don't. Big thing to remember is you make most of your money through your top performers. You don't want to dilute your top performers prematurely by taking too much money off the table rebalancing. You don't want to keep your top performer in balance with your mediocre performers. You've got to let your top performers run, I think, if you're going to potentially make a lot of money. So yeah, reweight maybe sometimes, depending on what you want to do, but just be cautious with the reweighting. I don't think be too aggressive with the reweighting. or you destroy the whole means that you've done so well in the first place.
Especially if it goes back against you, obviously, and you're buying more into it.
But you're always going to give back some money at the end. There's nothing wrong with giving back some at the end. It's just about having occasionally something will happen with the stock and will fall 50% overnight. So that can become a little bit, it's unlikely to happen, but it can happen, particularly when they rise really quickly. And if you've got a stock that's grown to 20% of your portfolio, the prospect of it halving overnight means you're down 10% overnight. It starts becoming, well, okay, this is no longer a relatively small position. It's a weighty position. So it just means thought should be given to what is the most effective way to manage the risk whilst not undermining what's made me the profit in the first place.
Yeah. Now I'm just conscious of time, Jason. Obviously, we've got some great questions here. I will do one more just from Earl, and then I might record some of these and we'll get into them next week, I think, because there are some ones around liquidity, and we can talk more about that next week. But just the last one here from Earl. What if a stock hits the exit, you sell it, and it bounces? Do you wait for a new buy signal, or stay out, or get straight back in?
Yeah, that's a really good question. It's one of the frustrations people have with exit stops or stop losses is that a stock will hit the exit point and then rebound and start rallying again. But look, this isn't an exact science. An exit point doesn't mean, if a stock triggers an exit point, it doesn't mean that it's going to spiral out of control like that example of Cleos. It may fall a fraction more and then start rallying again. But that's not a problem. The stocks that rebound don't ruin your portfolio. The stocks that don't rebound and you don't sell, they're the ones that ruin your portfolio. So it's not that we've got to stay in every stock that's going to go up. Some are going to lose along the way. That's just part of the game. The defensive strategy is to ensure we don't get a Cleos or a portfolio of Cleoses amongst all the stocks that we own. If it does rebound, look, my systematic approach will be it won't trigger a new buy signal for probably at least several weeks. So I won't get straight back in. When I've traded on a discretionary basis and it stops being triggered and then it's rebounded, maybe I would get in. It would depend on the circumstance. I'd need to look at the price action. It would depend what I was doing. So there's not a single answer for that. But I think the main answer is expect there's going to be frustrations, but don't worry about them because it's the disasters we're trying to avoid. And there's going to be a few we're going to miss. It's just the game.
All right, Jason, look, I want to thank you for your time again today. It's been great. I think I'm going to record some of these questions because they are interesting ones and we need to talk about them. We're just probably conscious of going a bit over time. Just once again, guys, note that none of the ideas we discussed today, you obviously need to do your own diligence there. Appreciate everyone's time. Please like and subscribe on the channel once again. Obviously, Jason is from Motion Trader. We're a joint effort here. It's not just one big promotion for one of our companies, but it's just trying to give traders great education is our main goal here, right? So, feel free to chuck in any questions on the comments below as well. And other than that, Jason, I look forward to speaking to you next week.
Yeah, look, Roger, that's been really good. And just quickly, I just saw a comment from Dean who just asked whether this is a big promotion for Motion Trader. And I talk about Motion Trader a lot in these because that's what I do and that's where I trade. And if you want to understand my approach, it's I can't help but talk about what I do and my own personal portfolio. It's what I do. So if you want real life examples, yeah, I'm going to talk about Motion Trader because that's how it all happens. I can pretend I don't do things myself, and we can just do hypotheticals. But I don't see the educational value in that. I think the best education comes from seeing success and failure from individual trades that have actually happened. That's where you get the real emotional value of the sting of a loss or the triumph of a win is by seeing the real thing, not just seeing hypothetical. So by the very nature of that, I am going to talk about Motion Trader a lot, because that's where all my examples come from. It's it's real life. It's talk the talk, walk the walk stuff. I don't just come in and read from a technical analysis book. I'm talking about what I've actually done through my career, and that I'm still doing today. So hopefully people will find that interesting. And look, Rog, it's been really fun. Been a lot of fun talking again today. And look forward to next week.
Right, fantastic, guys. Well, I hope you wish you all the best and have a great week in trading, and we'll speak to you next week. Take care. Bye-bye.